Imagine this for a moment. You've just poured a significant chunk of your hard-earned money into a promising stock. It's a company that has consistently shown growth, and its future prospects look bright. As time passes, however, things start to go south. The stock price, instead of shooting up as you'd expected, begins to plummet. The loss is mounting, and your heart rate is skyrocketing. It feels like a nightmare, doesn't it? Welcome to the world of trading, where the unexpected can become the norm in the blink of an eye. But fear not, because even in the most dire of circumstances, there's a safety net that can protect your investment. It's called a stop loss. Stop loss is your knight in shining armor, your guardian angel that steps in to prevent further loss when a trade goes wrong. It's a predetermined price at which you decide to sell the stock if things don't go as planned. Take the story of Mark, an experienced trader. Mark had bought shares of a technology company that he believed would soar. But instead, the company reported a huge quarterly loss and the stock price started to fall. Mark had set a stop loss at 10% below his purchase price. When the stock hit that price, it automatically sold, preventing him from suffering a larger loss. In a perfect world, every trade you make would turn a profit. But we all know that's not how it works. Sometimes a trade goes south, and that's where the risk-to-reward ratio comes into play. The risk-to-reward ratio is a measure of the potential loss in a trade versus the potential gain. It's about balancing the scales and ensuring that the potential profits outweigh the potential losses. Here's an example. Meet Sarah, a seasoned investor. When she identifies a promising trade, she calculates her risk-to-reward ratio. If she's risking $100, she wants the potential to make at least $200. That's a risk-to-reward ratio of 1:2. If the ratio doesn't meet her criteria, she doesn't make the trade. A good risk-to-reward ratio ensures that even when some trades go wrong, the successful trades more than make up for the losses. So, what's the takeaway here? Trading isn't about winning every time. It's about managing risk, setting boundaries, and making strategic decisions. It's about knowing when to hold on and when to let go. In your next trade, consider setting a stop loss. It might feel like admitting the possibility of a loss, but it's actually about embracing the reality of trading. It's about safeguarding your investment and your peace of mind. And remember, always calculate your risk-to-reward ratio. It's not just about how much you could gain, but also about how much you're willing to lose. Trading is a journey filled with ups and downs, but with tools like stop loss and a well-calculated risk-to-reward ratio, you can navigate the stormy seas with confidence. So go ahead, step into the world of trading, but remember, always trade smart, not hard.